Hi, everyone. This is Rohit from Lifestyle Mastery, and today I'm excited to have Jake Gibson, who's a founding partner of Better Tomorrow Ventures, an early stage venture fund focused on building the future of fintech. Prior to Better Tomorrow Ventures, Jake had co founded NerdWallet, a site dedicated to helping consumers make better decisions with their money. Welcome to the show, Jake.
Yeah, thanks for having me.
Awesome. So you have a very interesting journey. You started your journey with Wall Street, and then you quit your job. But what got you really interested to get into the world of startups?
Yeah, so I guess there's kind of two tracks here. I've had kind of a deep passion for both money and finance as well as technology from a very young age. I mean, some of my formative memories on kind of the money and finance side of things. I didn't grow up particularly well off. My parents were divorced when I was very young, and I grew up with my mom while my dad was more or less like not in the picture. Um, I remember at a very young age going into my mom's bedroom and she was crying because she couldn't afford to pay the bills. And this was something that we struggled with through most of my childhood, and kind of led me. It basically kind of made money like a central topic to me from a very young age. And when I got really into math, I naturally wanted to apply that to like thinking about money. And when I got into MIT, kind of went on a dual track where I was studying math and finance, and that eventually led me to Wall Street and kind of a lot of my subsequent things. And then at the same time, while I alluded to the fact that my dad wasn't really part of my life, the few times that he did manage to kind of drop in and spend time with me, he got me really into computers. It was like the one thing that it's the one thing that he did. So from got like single digits. I mean, I was probably like 6, 7, 8, 9 years old, kind of in that ballpark, when we were building PCs from scratch back before we didn't even have hard drives half the time. You'd have to boot everything from a 5 1/4 inch floppy disk, and there's no operating system or anything for the most part. We're working off of like MS DOS and then eventually learning QBasic. And I just got so obsessed with computers. And then my mom was able to get me onto like Prodigy and CompuServe and AOL and the early kind of internet things. And that just kind of blew the doors off for me and really opened my eyes. So, um, in addition to kind of finance being kind of a central theme to all of my life, like technology and software and the internet and being able to create things from nothing has kind of always been there as well. I actually went to MIT with the intention of studying computer science, getting into the tech industry, but the internet bubble burst. And, I was seeing all these investment banks showing up on campus that were still recruiting. And so ended up kind of focusing more on the math and finance side of things. And then, like I said before, ending up on Wall Street. Um, then I came full circle after the financial crisis when I decided to leave JP Morgan. It's a great learning experience being through the financial crisis in a seat like that. But at the same time, um, I hated Wall Street, and didn't really love the culture. I didn't feel like I was learning and growing. I didn't feel like I was building anything of value. And meanwhile, I was watching like friends of mine from college starting all these awesome companies, and I'm spending half my time on the trading floor, like on my new iPhone, like flipping through TechCrunch rather than paying attention to the markets, and kind of realized that it was time to go. So I ended up leaving Wall Street at the beginning of 2010 with the intention of kind of setting up shop in Silicon Valley and getting involved in the tech world. Um, yeah.
Very interesting. And you mentioned that you had a stint with JP Morgan Chase. You went on to become a senior person over there, like vice president. A lot of listeners are looking to leave their jobs and build their own businesses. What advice would you give to them when you have a high paying job and you have your bills to pay and responsibilities to take up? But how should they take up the next career jump, because it was a big shift. You're starting NerdWallet. What advice would you give to them?
Um, I'll say like having a high paying job is a very fortunate position to be in. um, Most people who hear this won't be able to act on the kind of advice that I would give. But my view was like, on Wall Street, there's this kind of long running joke that everybody has a number, like capital N. So like once you hit that number, you'll leave, because nobody who works on Wall Street is doing it for fun. They're all doing it for the money. And so there's some amount of money, presumably, that you'll make where eventually you'll just move on and not stay on Wall Street. The joke, though, is that the number goes up every year. And so you just end up staying forever. And it's true. There's a lot of kind of what they call the hedonic treadmill, like your life accelerates, your lifestyle accelerates kind of ahead of the curve. And so I would be sitting across the table at dinners and stuff like that with these people that were complaining about like living paycheck to paycheck, or like, so-and-so isn't paying me enough. And I'm like, you just got through telling me you have a house in the Hamptons, like a condo in Manhattan, you have 4 kids in private school, you have like 2 Range Rovers, and you pay and this was like the most hilarious part. They talk about paying their wives $10,000 a month in allowance or something like that and complaining about it. Like, go to hell. Like, like that's your fault. Like, and so my view on all this was like, for me, my number actually went down every year, which is why I actually left eventually. Everybody that I worked with thought I was absolutely insane when I left. Like, I was on a great desk, I was on track. Probably the year after I left, I probably would have made $1 million. And I was leaving for basically nothing. Like, I was gonna, it wasn't a thing back in 2010. Startups weren't nearly as kind of popular and part of the zeitgeist as they are today. So everybody I worked with were like, your boss loves you, you have the potential to make a ton of money, you're at a great bank on a great seat, and you're leaving it to go do basically nothing. But for me, it was just that, like, it wasn't worth staying anymore. My number just went down every year, and eventually I crossed the threshold. It was time to go. And so my advice for anybody else is just like, keep your lifestyle reasonable, like stay behind the curve, not ahead of the curve, and save your money. Because basically, I didn't have that much money when I left JP Morgan, but I had a lot more than most people. And I figured my wife and I had probably 2.5 years of runway for me to just go figure my life out. And I was, this is also, it's very risky. Like, I was perfectly willing to burn all that runway if I had to, in order to build a new life and kind of start from scratch. And then thankfully I had a friend who was much smarter than me, who was starting what would become NerdWallet, and I kind of just jumped on and grabbed onto his coattails and rode that. But we went 2 years without paying ourselves. So it was a real risk.
Got it. And you started NerdWallet, but did you start it on the side, or did you leave your job? And how did the whole story start with NerdWallet?
Yeah, it was after I left JP Morgan. I was basically just like helping Tim out part-time. So Tim and I, we've known each other since 8th grade, and good friends. We were kind of partners in crime on a bunch of stuff that we did in high school. And he had left his Wall Street job in 2008 as well, and started kind of tooling around with this idea that would become NerdWallet. And originally my thought was like, well, Tim's staying in New York, I'm moving to California, I'm going to help him out on some stuff. Like, it'll help me learn, help me figure out what I want to do in my life. Because like when I left JP Morgan, I literally had no plan. It was just, I'm going to move to California and figure it out. But I loved working with him, and I was learning a lot, and I was getting to code again for the first time in 6.5 years or something. And really felt like we were, I don't know, it felt like we were doing something important. And I found myself working like 13, 14, 15 hours a day and just not even blinking an eye, because it was just, all of it was so interesting. And so I just jumped on full time. And initially it was, I moved to California, he stayed in New York, and we were kind of thinking of it as like a lifestyle company. Figured we'd maybe get it up to like $1 or $2 million in revenue, and then we could live pretty comfortably off of that, or sell the company, collect the proceeds, and go start something else. That was the extent of our ambition at that time. We had no idea what we were going to end up building, and didn't even see ourselves as like kind of typical Silicon Valley tech founders. Like, went to school with Drew from Dropbox. Like, we knew we were not in that echelon, and we're not trying to build that. Like, we just wanted to do something interesting and do something impactful and maybe make a little bit of money in the process. Uh, and fortunately, I stayed on and I mean, thanks largely to Tim, I was able to hold on long enough to it worked out.
Got it. And you've been part of NerdWallet, which is a a personal finance company. And what do you think is the ideal investment portfolio? How much money would you recommend putting into high risky investments like cryptocurrency and angel investing, especially after what has happened with COVID? Do you believe in higher risk assets for younger people who would want to grow their assets?
I am probably one of the single worst people to ask for like actual investment advice, actually. So similar to how when I left JP Morgan, I had basically just planned to burn all my savings to start my next phase of life. When I left NerdWallet, um, I knew that I wanted to build a new life and a new career for myself again. And I basically invested 80% of my net worth in uh in like high risk illiquid assets. And with the exception of like buying a house, everything else was, I mean, because that's illiquid, but not, maybe not as high risk. Everything else was just high risk illiquid investments. I invested in VC firms, or VC funds. I invested in startups, a few like kind of hedge fund ideas that were related to the fintech ecosystem, um, and basically leveraged the little bit of capital that I had to build the network and the track record and the reputation and everything that would eventually go on to helping me start a fund. So I've always just viewed capital as a tool. I think largely because I didn't grow up with any money. I don't have like an emotional connection to the money. I feel like if I'm not using the money to do something important, it's not relevant. And so my whole thing has always just been to like take the money that I have. And I mean, now I have kids and stuff and I have to think about it a little bit differently, but I'm still much more aggressively invested than any financial advisor would ever advise you. I think for your average person off the street, like just stick it all in passive ETFs and don't think about it, because the problem is you're not going to think about it most of the time. And you're not going to outperform the market if you're not spending 24 hours a day thinking about the market. And frankly, you probably have much more interesting things to do with your time. Like I had a buddy texting me over the weekend that was like, should I invest? Like, I'm going to sell some of my startup equity. Like, what should I do with the money? Valuations seem really high. Like, do I invest it all now? Do I wait? Do I put it in Wealthfront for the tax loss harvesting, or do I put it in like a Vanguard target retirement fund? And I was like, look, dude, everything that you're describing is basically like an optimization. All that matters is like put the money somewhere. Like at the end of the day, like the extra basis points you're going to earn here and there, like not going to change your life. So like, if you're worried about the valuations and it's going to like keep you from sleeping at night to just dump all the money into the market today, like just do it in phases over time, like invest a little bit at a time. Like it's more about managing your psychology than managing your money at the end of the day. So like do whatever's going to help you sleep at night. Just put it in whatever's easiest to manage. Also, like if you have to have accounts all over the place that are doing like tax loss, all this other stuff, and you're just trying to like clip a few extra basis points, just find a cheap Vanguard place and just stick it all in there and don't think about it again. Like that's honestly the best thing you can do. I think most people punish themselves by thinking too much about it, because you either like stress yourself out, impacts your life, or you make irrational decisions. And so the best thing is just like do whatever, manage your psychology, rather than thinking about your money.
No, I think you're right. Putting on a Vanguard and just managing your psychology is very important, especially during the times of COVID. And Jake, you've been into fintech for such a long time. What are the major categories in fintech which you're really interested in? When you look into investing into startups.
Yeah, to be honest with you, like it's hard for me to put it into categories because we invest in everything. Like anything that even ostensibly touches money is in our wheelhouse, is the way that we view it. But that said, like one of the trends that we've been tracking for the last couple of years, and it's gotten to the point now where it's like basically a meme, so I'm not going to say anything that nobody here has heard, but this whole concept of embedded fintech and lowering the barriers to building and lowering the barriers to access financial products I think is a huge deal, in the same way that, AWS and kind of web development frameworks and various sorts of like database virtualization and stuff like that, like all these enabling technologies over the last 20 years at this point, compounded on each other to where like you don't actually have to be able to write a single line of code to launch a company now, and it
Yeah.
costs whatever, $9 or whatever it takes you to get a domain to get a
Right.
company up. So it's pretty amazing, and that has not been the case in the fintech space, because it's just, there's so much legacy infrastructure to deal with and so much regulatory infrastructure and things like that. So now we're starting to see these companies come along that are building APIs to kind of overcome a lot of those challenges and make it much easier and much faster for a company to build and deploy financial products. And so where we see that going is like the last 10 years or so, it's kind of effectively like, it was all in the fintech world, it was like all fin with very little tech. The tech was just like integrating with all these legacy systems and maybe like a nice little front end on top of it. But really the focus is like, I'm still selling the same product and the same business model as the traditional financial ecosystem, as the traditional banks and insurance companies and stuff. But now that we have all these APIs and all this infrastructure and all these like interesting new kind of enabling technologies to build upon, we think the future is going to be a lot more about the tech, with the fin almost like abstracted away in a lot of sense. And so that's kind of where we're focusing, is like, what does the future of finance look like? And like, how can we focus more on solving unique problems for unique end users rather than building commodity products and just trying to sell them to everybody? And so that's kind of where we're focused, is like, how do you take this enabling technology, build much better kind of value added software, and software that solves like real pain points for real users, that just also happens to integrate finance in really interesting ways and almost abstracts away like the UX and the UI of those things. So you're not thinking about, where's my checking account, where's my savings account, where's my auto insurance. You're thinking about, here's my like, here's an app that I use every day to manage my life, and I have to pay people through this app, and I have to save money in this app and things like that. And it's just kind of automatically built in, very similar to how things work with these super apps in like Asia, and now it's starting to be more of a thing in like Africa and South Latin America as well. We think more of that's going to play out here as well.
Got it. And I was wondering which are the major customer segments which going forward the fintech companies can serve. Millennials are a very interesting customer segment, but are there any specific focus on startups which should serve these customer segments?
Yeah, I mean, I think there's a lot of them, and I'm not nearly creative enough to come up with them, but like, we already have investments in companies that are building kind of interesting software combined with financial services for like small and mid-sized farmers, for example, and small and mid-sized trucking companies, or really just truckers, because it tends to be just like an individual who owns or leases a truck and is running their own trucking operation. And I think there's a lot of segments like that where it's a large population. They're not well served by the existing financial services, because those tend to try to be like everything for everyone. And so if you can build software that helps them manage their businesses or manage their lives in a much better way, and tie that directly into the financial services, which also kind of tighten the user experience loop and provide a much stronger value proposition, then I think like there's gonna be so much legs to that theme. And so farmers and truck drivers are two that we're already invested in. And another one that we've seen come up quite a bit lately is like healthcare workers. So if you look at like nurses and doctors and stuff like that, they have a pretty unique financial situation. Like, they do tend to live their lives in a way where they're like essentially poor for a long time, and then just one day they're making a ton of money. But at the same time, they financed all those previous years with debt. So they're going to have a lot of like federal student loans, private student loans. Shit, sorry. I should have kicked him out earlier. But Yeah, healthcare workers have a pretty unique situation because they they spend so much of their lives like in school making no money and just accumulating debt, and then one day they wake up and they're making a bunch of money, but now they have to unwind all that debt, and then kind of manage how do you start preparing for retirement and things like that with this unique situation. Um, so healthcare, and it's a huge population and it's growing incredibly fast. So like that's a perfect segment for where we should be developing better financial services.
Got it. And I wanted to understand what made you leave NerdWallet and start Better Tomorrow Ventures with Shield Minot.
Yeah, so that was actually a long journey. It wasn't an immediate thing. So when I left NerdWallet, the original impetus was my kids were born. I had twins and didn't think that I could simultaneously manage kind of running a fast growing startup as well as kind of being the kind of father that I wanted to be for the two little ones. And so I ended up stepping down basically to go home and take care and spend time with my kids and take care of my kids. And it also kind of happened to be, NerdWallet was at a inflection point in terms of growth. We were able to bring on some really sharp operators that were kind of much better at these things than me to kind of help lead NerdWallet through that phase. And so it was kind of the perfect opportunity for me to step away. I took a bunch of time off right after that. And then when I was very similar to when I left JP Morgan, like spent a lot of time thinking about, well, what do I want to do next with my life and how do I get there? And like, what advantage do I have? Like when I left JP Morgan, it's like, oh, I have a little bit of capital, I have runway, so at least I can figure it out. And I know when I'm going to get into the tech world. When I left NerdWallet, it was kind of similar. I was like, well, I have some money saved up, and I don't really know at this point, it was like, I don't really know what I want to do. So I'm just going to use this money to kind of take my time and figure it out as I go. And where I landed was actually angel investing. So originally I started out as kind of mentoring and advising early stage startups, helping out friends of mine and stuff. But enjoyed that enough that I decided, well, why don't I kind of start putting my money where my mouth is when I start investing in some of these companies? And that'll also be a forcing function. Like if I'm kind of make it my focus to like find great companies and invest in them, that's going to force me to like meet a bunch of people, learn a lot, just kind of generally build this network and build this experience and this track record. And that kind of puts me in position no matter what I decide to do with my life. So like if I decided to start another company, I'd have a much better kind of mental map of what's interesting, what's not interesting. I know a bunch of other companies, I know a bunch of investors, and just generally would like know a bunch of operators and other people that might want to work with me on it and stuff like that. I knew that was probably the lowest probability, but was on the list. Or if I decided to join a company in kind of an early stage capacity, similar thing. Like I'd have the network, I know the companies, I know the investors, and would be in a good position to do that. Similarly, like if I wanted to join a VC firm, if I wanted to start a VC firm, or if I just wanted to keep doing what I was doing and just angel invest forever, then I'd be in position for any of those things. I just figured angel investing was the best way to like optimize that or like maximize optionality for these things. And so that's what I opted to do. And I actually ended up doing that for about 5 years. I invested in about 90 companies over that time. I actually was brought on by Index and Lightspeed Ventures to be a scout for them briefly and kind of wrote some checks on their behalf. So about 30 of those 90 are on behalf of those two funds. And then along the way, as I'm like kind of making the rounds and meeting companies and meeting investors and stuff, I was doing office hours at 500 startups, and I met Sheil. And he was starting a fintech focused accelerator called 500 Fintech, and loved Sheil, loved what he was working on. Actually really loved the companies that he had brought in for his first cohort there. There were 6 of them. I ended up investing in 2 of them personally. And then I ended up investing in the fund. I ended up helping him raise the fund. I was pretty adamant at the time that I don't want to do this full time. I don't want to be an employee of 500 startups. I don't want to limit my optionality, going back to my previous point. But I like what you're doing here, and I will help out however I can. And did that for 3 years, and like the fund ended up doing very well, and or so far. I mean, story's not fully over. But we're probably one of the highest performing funds in 500 startups history, and maybe one of the highest performing funds of that vintage across the board. Even benefiting from the fact that it's a very small fund. It's only $15 million. And so we really enjoyed that experience, but there were some issues with 500 startups that came to light in 2017. We opted to just deploy the money that we had raised already, not raise any more capital, not do a second fund at 500, and kind of eventually wind down 500 Fintech and then move on and do our own thing. And after some time kind of deliberating on what our next thing would be, we decided to start a venture capital fund. And like in the interim, like we interviewed a bunch of VC firms. We tried to see if there was maybe a place for us out there in the ecosystem already, but kind of ultimately decided that we wanted to do our own thing. Like we still kind of felt like operators and entrepreneurs at heart, and didn't want to get caught up in a lot of the like politics and stuff that come with larger funds. We wanted to build like we kind of always have done, and so that became Better Tomorrow Ventures.
Got it. And for Better Tomorrow Ventures, what is your investment thesis? What do you look for investment fintech startups when you invest into them? Is market or team more important? How do you evaluate startups?
I mean, it's definitely more art than science. So it's hard to, I would say market and team are by far the two biggest things, but it depends on the company. It depends on the market. It depends on the team, which one is more important in any given deal. Some people tend to draw a hard line of like, if the market's big enough or it's growing fast enough or whatever, it doesn't matter who the team is, and vice versa. I don't know. I tend not to draw hard lines on anything. It just kind of depends on the company. But generally speaking, like we invest, like I was saying before, in anything that is anywhere near the financial services world. Payments, banking, lending, insurance, real estate, consumer, B2B, you name it. We've dabbled in crypto in the past, though it's not like kind of a core focus of this fund. But it's only a matter of time, I imagine, before we make some crypto investments. And so it's a little bit of everything. And we've also invested in a handful of companies that aren't technically fintech companies, but given some of the trends that I was talking about before with like embedded fintech and kind of companies starting to leverage technology to distribute financial products, even if they're not financial services companies at their core. We've also invested in a handful of companies that are more like marketplaces or vertical SaaS companies that we think will look more like fintech companies in the future, but aren't today. So it's a little bit of everything. And we're pre-seed and seed. We're typically writing up to $1.5 million checks. We're typically looking for at least 10% ownership. And then the reason for that is, like I was saying before, we are operators and entrepreneurs first. When we partner up with a company, we like to get involved and help them build. Like we only invest in companies where we would want to be part of the founding team. And to the extent that we can, I mean, we're VCs, we're not founders, or we're not operators in that sense. Like we try to be instrumental in those early days of helping shorten learning curves and accelerate companies out of the gates, but really rolling up our sleeves and bringing all of our resources to bear to make it happen. So one of the things we've learned over the years is when you're writing 25 to 150K checks into companies and you own a tiny piece of the company in exchange for that, it doesn't justify all the time and effort that you're putting in to help those companies grow. And so we've had to kind of be adamant about investing in less companies, but owning more of those companies and being more of a financial partner, but also being able to be like a real operating partner as well.
And you made an interesting point about investing into marketplaces and SaaS company as well. But do you think every company can every company become a fintech company?
We do think so. And you're already kind of, actually, funny enough, the front page of our pitch deck for this first fund back when we kicked it off a couple of years ago was everything is fintech. And it's because any company that has a data advantage and a distribution advantage, that means if you have like a relationship with your end users and you're collecting interesting data on them, you kind of have built-in distribution, and you have built-in like you know enough about them that you can tailor financial services to them, either underwriting loans, underwriting insurance, or at least knowing like, you know, you need to make payments, or you know different things about their lifestyle that they can help you with these things. And I mean, if you look at just what's going on in the tech industry more broadly, all of the biggest tech companies are in financial services now. So that just kind of leads me to believe that like kind of all of anyone who wanted to be could be involved in financial services.
Got it. And when it comes to a team, do you think it's necessary for fintech startups to have a team who have experience in industry, or financial industry, and like for example, Stripe and with Collision Brothers, they do not have any finance experience, but they went on to build one of the world's largest payments company. But do you look for founders with fintech or financial experience?
Not necessarily. I mean, it helps because if you don't have it, you're gonna have to hire for it. Like Patrick and John didn't start with the finance experience, but those guys also just learn extraordinarily quickly and they hire well. So you can kind of build that muscle yourself. You don't need to come with it. We like to think that we are that muscle for a lot of founders, especially those who don't have the background in financial services. In terms of like helping you build out an early or like helping you figure out where the holes are in the early team, helping you build out the early team, or even just helping you shortcut a lot of those learnings just from our own experience. So like if you're a lending company, there's a bunch of things you're going to need to know before you can lend your first dollar, and you're also going to need lending capital and stuff like that. It's not going to be on your balance sheet. Similar with insurance, like there's a lot of things that you need to know before you can sell your first policy, and you also need like a fronting carrier, you need reinsurance capacity, stuff like that, to back the policies. And if you're a founder that doesn't know anything about financial services, trying to build a company in this space, like A, you might not know these things, and B, you might not have the network to get connected to the right capital providers and stuff like that. We provide a lot of that. So I think it's a big part of the reason why like having a fintech focused VC fund is actually valuable, and raising money if you're a fintech company from a fintech focused VC fund is valuable, because fintech is it's like financial services is this whole other world beyond kind of consumer tech or beyond kind of B2B SaaS or whatever. And if you're a generalist investor that hasn't spent a ton of time learning about the intricacies of banking, payments, lending, insurance, and all these other industries, then you're kind of at a disadvantage.
Got it. And how do you look at founder VC dynamic, especially with so much of capital supply? Do you think the dynamics have totally changed since there's so much of supply outside?
Yeah, and we don't even have time to like even touch the surface on a question like that. But yeah, I mean, there's a huge supply of capital out there. There's a gazillion VCs. There's a gazillion angels. There's also now every angel has a rolling fund, and so instead of writing 10 to 25K checks, angels are now writing 100K to 500K checks, and it's it's made our job a little bit harder because it's a lot more competitive now. We started this fund with the idea that there just wasn't enough capital going after early stage fintech companies, at least not the ideas that we thought were most interesting. And it was more kind of generalist capital that didn't have the same lens on the space and the same expertise in the space that we did. And so we started Better Tomorrow BTV to solve that problem, and now that problem doesn't exist anymore because there's way too much capital. We still think there's not nearly enough people with the right experience investing at the early stages, but there's a lot of great angels out there now that have come out of fintech companies and are backing early stage fintech companies. And then there's a few other funds like us that are kind of starting to do stuff like this as well. So now the challenge is like, well, how do we just prove our worth and kind of stay disciplined, but also provide as much value as possible to the founders that we back, so that we can solidify ourselves as the early stage fintech focused fund. It certainly created more of a challenge for us, but it's also like, people talk about things as if what's going on in the financial markets is crazy. I mean, it has been kind of crazy over the last year, but it's also just a continuation of a trend that we've been going through for the last 13 years since the last financial crisis. So who knows if the music is ever going to stop. Like, you kind of just have to play the game, or play the cards that you're dealt, I guess is another way of putting it, and not focus too much on that. So that's kind of how we think about it. It does seem like if you just write fintech on a napkin and you're a founder, you can raise as much money as you want at whatever valuation you want. And it's great for founders. And I think it's going to be great for innovation in this space.
Got it. And how do you think about tech exodus, which is going away from Silicon Valley, and do you think after COVID it's going to be a fundamental shift where you don't have to be in one ecosystem, and big companies can come out of anywhere in the world?
I mean, I think it's been the case that big companies could come out of any place in the world for a while now. There is a strong network effect in Silicon Valley, and maybe that has been weakened a little bit by COVID. But generally, my view is whenever people start pounding the table that, like, Silicon Valley is dead or New York is dead or whatever, it's just like, it's always overblown. It's always kind of for the headlines and everything. And, there's a very vocal minority in Miami right now, basically trying to turn Miami into a tech scene. And I think it'll work. Like, there's a lot of powerful people there that are pushing that narrative so hard that you're going to drag enough people there to get some things going. Are you going to transplant all of Silicon Valley to Miami or Austin? No. But I think it's good for the world, and it's good for the tech ecosystem for these things to be more distributed. It wasn't great for anybody that like 99% of the world's future wealth was going to be built in like a 40 square mile area here in California. I don't think that was ever going to be sustainable. So seeing these things, kind of seeing this distribution of talent and distribution of opportunity, I think is great in general.
All right. And, recently Brian Rickwatts, who's the founder of Latitude and was a big investor in Latin. And there are a lot of interesting fintech companies which has come out of Latin America. Do you see a major growth coming out of developing countries, especially Southeast Asia and Latin, or developed?
Yeah, so we had a very active Q1. And when I went back and did the numbers, half the deals that we did in Q1 of this year were overseas. Heavily focused on Latin America and Southeast Asia. And so our view there, and this is part of our pitch when we raised the fund, was, we have all these kind of strong opinions on what's going to happen to financial services in the US and how technology is going to be great and everything. But the other trend that we've seen developing is 500 Fintech was a global fund. We invested all over the world. The other trend that we've been seeing is, in these developing countries, you have generally young, growing, increasingly wealthy, and increasingly educated populations that are digitally native. And unlike the US, there's not nearly as much kind of legacy infrastructure to build on top of, which just means that there's you have a ton of demand, and then you have kind of a greenfield opportunity to build financial services from the ground up to meet that demand. So we have, I think, 3 companies in the portfolio now. They're in Latin America. We have one in Southeast Asia. We have one in India. And I think we may even have more. You lose count after a while. But these are definitely areas of focus for us because we just feel like there's so much more opportunity to do interesting things without kind of being held back by the existing industry.
Got it. Jake, I just quickly want to do the top 3. What's your favorite business book?
My favorite business book, the one that I recommend to my founders the most is called The Advantage. I know there's all kinds of books about business and stuff that I think are interesting or whatever, but The Advantage, I think, has the advantage of being, it's about management and how to manage like high growth teams and how to manage culture within kind of fast moving innovative organizations. And it's spot on. It's a fairly short book. It's easily digestible. It's all actionable. And I think it's the number one book that I give every new founder who has to learn how to like build and manage an organization and hold people accountable, know how to communicate within an organization, like all the things that I struggled with the most in starting NerdWallet, and largely failing at. I think this was the best book I have found on dealing with those issues. It's called The Advantage.
Advantage. We'll put that in the show notes. And if you could go back in time when you started working on Better Tomorrow Ventures, what is the one thing you would have focused on or done anything differently?
That's a hard question for me to answer, because I think we got very lucky. I think we did a lot of things right. I'm sure we did a bunch of things wrong, but we also got very lucky. And so it's hard to say that, like, it's hard to have regrets with the way that things panned out. Like, if anything, maybe we would have done this sooner. Like, we let the 500 Fintech fund drag out for a long time. And then we spent a bunch of time like interviewing at other funds and stuff. And we probably should have just gotten off our asses and started building BTV sooner, I think, is the only thing that I would maybe do differently.
Got it. And do you have any favorite online tools, for example, Gmail, Slack, Zoom?
All of the answers that immediately come to mind are probably not particularly new or interesting. So like Superhuman, I spend 90% of my waking hours in Superhuman. Between Superhuman and Twitter, those are the two tools I tend to use the most. The other one that I'm a big fan of, and I'm an investor here, so I have to caveat this, but company Alto IRA, especially nowadays with kind of Biden's tax plan and stuff like that, I think it's going to get a lot more popular. But I've traditionally done a lot of kind of private investing out of my IRA. And I was a customer of a few different other companies like Pinsco and Millennium Trust and stuff like that. They're supposed to help you do these things, investing in hedge funds, VC funds, startups, stuff like that out of your IRA. And they're all terrible. And so I ended up investing in Alto a few years back because they were building basically like self-directed IRA 2.0. And I was just obsessed with that idea. I was like, I need this for myself. I was actually their first beta tester. And to this day, like, I buy Bitcoin in my IRA through Alto IRA. Like, I've invested in some of my friends' VC funds through Alto IRA. And it's probably the only like financial app, even for me as a fintech investor, it's probably one of the only financial apps that I use on a like weekly or monthly basis.
Got it. I think that's a app which not many guests have talked about. Which only put that in the show notes. Jake, what is the best way people can reach out to you and know more about Better Tomorrow Ventures?
Generally, Twitter is where I spend most of my time. So I'm at I am Jake Stream. So that's IAMJAKE Stream, STREAM.
Got it. Yeah, we'll put that in the show notes. Jake, thank you so much for taking our time and speaking to us. I really enjoyed my conversation with you.
Yeah, likewise, man. Thank you.